The question on every investor's mind right now is, are we going to see the stock market boom or crash in 2024? And in order for you to really predict what's going to happen with the stock market in 2024, you have to start by understanding what influenced the stock market in 2023. Take a look. 2023 started off with the stock market booming out of 2022, but by March things had flipped because of the banking crisis causing stocks to fall. However, the stock market free fall didn't last very long because the FDIC, the Federal Reserve Bank, and the government got together and they created new programs to essentially save the banking crisis that was happening. And so by July of 2023, the stock market was breaking new highs for the year. But then came October after a few months of not so great inflation reports and some worries about the economy. So we saw the stock market fall into correction territory, meaning 10% off of its highs. But then, of course, by December, the stock market whipsawed back upward, breaking new highs because people got very optimistic about inflation and the economy. Now, after this wild roller coaster that we saw in 2023, everybody has an opinion about what's going to happen in 2024. On one side of this equation, you have people like Wells Fargo and JP Morgan who say that the stock market is going to have a rough year in 2024. But then on the opposite side, you have people like Bank of America and Deutsche Bank who say that the stock market is going to rally and break new record highs in 2024. Now, of course, nobody can perfectly predict where the stock market's going to go in 2024, and that's not the purpose of this video. Instead, I want to go over 4 major factors that we know which will be influencing the stock market in 2024. But before I jump into that, just so there's no confusion on this, if you are a passive investor doing something like dollar cost averaging, it does not matter what's happening in the markets in the short term. All you keep doing is buying every week, every 2 weeks, every month, and you don't worry about the short-term swings because you are a long-term investor and you just keep buying. If the market goes up, you keep buying. If the market goes down, you buy more. That's the way that you win as a passive investor. And if you want more financial education, remember we have a free ebook at Briefs Media that walks you through the basics of how do you build the mindset of an investor, to how do you start saving money as an investor, to how do you actually invest your money, how do you generate cash flow, what are the ways that you can invest your money as an investor, to how do you spend your money, how do you earn more money, and how do you protect your assets. This ebook is completely free. And if you want to download this ebook, that way you can start building your financial education as an investor, I got the link that you can download this ebook down in the description below, or you can go to briefs.co/ebook. The 4 factors that I want you to pay attention to in 2024 are number 1, the economy, number 2, the X factor, number 3, geopolitical risks, and number 4, the impacts of higher interest rates. Starting with number 1, the economy. The stock market doesn't always move linearly with the economy. Sometimes you'll see the economy boom and the stock market fall, and sometimes you'll see the economy fall and the stock market boom. For example, during the 2020 pandemic, we were in a recession, supposedly the worst recession since the Great Depression, yet the stock market was rallying while that was happening. So sometimes the stock market doesn't go in the same direction as the economy because the stock market has an emotional aspect to it, because the stock market moves in the direction based off of where investors think the economy is going to be in the future. So when investors are optimistic about the future of the economy, they'll put more money into the stock market, which causes stock prices to rise. When investors are concerned about the future of the economy, they pull their money out of the stock market, causing stock prices to fall. Now, that being said, you still want to pay attention to what's happening in the economy because that can give you an idea of where the stock market will be going in the future. Because our economy runs on spending. The more money you spend, the more money somebody else makes. When people are spending money, the economy is growing, which causes then stock prices to generally go up because people are more optimistic about the economy. And what we've seen happen up through now is that the American consumer has been resilient despite all odds, continuing to stay strong and spend to keep the economy moving. In other words, Americans are spending money like crazy. But the concern here isn't that Americans are spending money, it's how Americans are spending money, because Americans are spending money by spending money that they don't have. But here's the thing, and it's an interesting dynamic about our economic system. When Americans go into debt through credit card debt, or they pull out cash out of their homes, or they get they use debt to go out and shop and spend money, this is good for businesses because businesses get more revenue and they see bigger profits. It's good for investors because investors see their stock prices rise. But it's not good for the spender. It's not good for the consumer because now you're going broke to make everybody else rich. And based on the current spending patterns, Americans are on pace to run out of money sometime in 2024. Now, the reason why is pretty obvious. It's because Americans have been increasing their spending faster than they've been increasing their incomes. Now, part of the reason for this is because of the high inflation that we've seen over the last few years. But the other part is that Many people don't want to downsize their lifestyles even if they can't afford it anymore. Now the question mark here is, when will that breaking point be, and what will happen when that breaking point happens? Because if we start to see more and more Americans hit that breaking point where they can no longer spend money and now they have to use their money to pay down their debt as opposed to spending, how is that going to impact the economy? How is that going to slow down spending? Because if spending slows down, that means businesses make less money. If businesses make less money, that means businesses make smaller revenues, they make smaller profits. If businesses make smaller profits, well, that also means that investors could lose money as well. So that's the first factor you want to pay attention to. The second factor is what I like to call the X factor. And the reason why I call it the X factor is because this is kind of out of everybody's control. The X factor is decisions made by the United States government and the Federal Reserve Bank, especially considering that 2024 is an election year. Morgan Stanley put out an interesting report talking about the stock market performance during election years. Take a look. What they found is that during the 23 election years between 1928 and 2016, 19 of the 23 elections saw the stock market rise, while just 4 of those election years saw the stock market fall. On average, the stock market has grown by over 11% during an election year. However, that doesn't guarantee that the stock market is going to rise during an election year because, well, you have things like 2008, where the stock market fell by 37% during that election year. So what does this mean exactly from a practical perspective? Well, nobody wants to give up their power during a re-election year. Doesn't matter if you're a Democrat or a Republican, it's the same thing. And so because of that, sometimes you'll see policies passed to keep people happy, to make them want to vote for you again, which could also create a little boost in the economy. For example, what we saw happen in 2023 is that we know that the office market has been struggling. We know that office landlords are struggling. So the White House passed a $45 billion bill to subsidize office landlords, to give them essentially free money, subsidize mortgages and grants free money to convert some of these vacant offices to residential buildings as a way to provide more money to these investors and to help kind of boost that economy. These things can create inflation, but they can also boost the economy. And so we don't know what types of bills are going to try to be passed in 2024, which could help boost the economy or the stock market. Not to mention the Federal Reserve Bank also has an impact on the stock market, because if the Federal Reserve Bank feels pressured to maybe cut interest rates or stimulate the economy, that could also boost the stock market. Now, up until now, the Federal Reserve Bank has been pretty adamant on not wanting to cut interest rates anytime soon. However, if we see, let's say, more pain in the economy or more pain in the stock market, that could entice the White House to say, hey, you, the Federal Reserve Bank, you need to stimulate. You need to stimulate the economy, you need to stimulate the stock market. And if the Federal Reserve Bank feels that pressure to cut interest rates, that could also boost the markets. So we don't know what the Federal Reserve Bank is going to do. We don't know what the government is going to do. That's why I like to call it the X factor. Third are, of course, the geopolitical issues that we're seeing happen right now. Over the last few years, we've seen a number of things kind of arise around the world. We have the war going on between Russia and Ukraine. We have the war going on in the Middle East. And then you have issues like the BRICS nations that are working to create their own currency. They're working to create a currency that's backed by physical gold as a way to rival the dollar. So there's a lot of geopolitical issues happening in the world, while we're seeing a lot of conflict inside of the United States. And all these things can create more issues geopolitically. If the United States enters a war, that could dramatically impact the stock market essentially overnight. And so we don't really know what's going to happen here. I am not a geopolitical expert by any means, so I'm not going to talk too much about this. But one book that I really like about understanding the financial side of the geopolitical concerns that we're seeing right now is a book by Ray Dalio, Principles for Dealing with a Changing World Order. If I can leave you with anything on this topic, read that book. I think you'll get a lot of value out of it. And this brings me to the fourth point that I want you to pay attention to, which can have impacts on the stock market, which are interest rates. But not in the way that most people think. See, when most people think about the impacts of interest rates, they're thinking of how is it going to affect the housing market, or how is it going to affect the job market, or how is it going to affect, the general economy. But that's not what I'm talking about here. I'm talking about the influence of interest rates on where investors put their money. Because the stock market works like any other asset class. It works on supply and demand. If you have more buyers than sellers in the stock market goes up. If you have more sellers than buyers in the stock market goes down. So if investors are putting more money into the stock market, that puts upward pressure on stock prices, and stock markets go up. If investors are pulling their money out of the stock market and maybe into other asset classes, that pushes stock prices lower. So how do interest rates play a part here? And there's a lot of different ways that interest rates play a part, but what I want to talk about is alternative investment opportunities that could make investors rethink where they want to put their money. And what I mean by that is over the last year and a half, we've seen interest rates rise significantly. Now, what does that mean? That means if you want to go out and buy a home or buy a car with a mortgage or a loan, you're going to pay more interest. But the flip side to that is if you put your money into a high interest savings account, you can get a higher rate of return on your savings, which is kind of nice. Like going into 2024, you can see a 5% return on your savings account on an FDIC insured bank. Not bad. So the thing here is if you are an investor and you're sitting on cash, now you're going to be looking at your investment opportunities. One of these investment opportunities might just be keeping your money in a high interest savings account. That is a 4 to 5% guaranteed return. The alternative to that, if you don't want to put it in savings, is maybe you put your money into treasuries. You lend your money to the government because now the higher interest rates mean you get a higher rate of return by lending your money to the government. And now maybe you got a decent enough return from you there, 4 to 5% returns over there. Maybe you look at other bonds where now you can lend your money and get a better rate of return. Because this return that you get from a treasury is known as a risk-free investment. Lending your money to the government is known as a risk-free investment because you're going to get paid unless the United States defaults. And if the United States defaults, we have a lot of issues going on in the world. Okay? That's why it's known as the risk-free return. So now investors are looking at where should I put my money? And if you can get a guaranteed, let's say 4 to 5% return without any risk, and then you have to compare that to putting it into the stock market where maybe you can get a 10% return, but it's more risk. Now your job as an investor is to decide what's a better place to invest. Because if the option was you can maybe get a 10% return in the stock market, but it's risky, or get a 1% return in the treasury market or a high interest savings account, well, now there's a big spread here. That 10% return seems a lot more attractive when the alternative is a guaranteed 1% return. But when it's a guaranteed 4 to 5% return versus a potential 10% return with all the other issues going on, what you're seeing is a lot of investors are saying, you know what, maybe we'll just put our money into treasuries. Maybe we'll put our money into the high interest savings account and avoid some of that risk for the short term until we see what's going to happen with the election, until we see what's going on with some of these geopolitical issues, until we see what's going on with the economy, until we see what's going to happen with the jobs market. And so what we've been seeing happen is some investors are kind of putting their money into the sidelines or in alternatives to the stock market because now you can get real returns or some decent returns on your money outside of the stock market in places like bonds and high interest savings accounts, 4 to 5%. And what does that mean? Well, going back to what I said in the beginning of this point, is if more money is going into the stock market, that pushes stock prices up. If more money is coming out of the stock market, that pulls stock prices lower. And if we continue to see high interest rates, and if the Federal Reserve Bank raises interest rates more, that could make some of these alternative non-stock market investments more attractive because you could get higher guaranteed returns. So now when you have a higher guaranteed return, you would need a higher rate of return from the stock market to justify taking on that additional risk. But there's also all the other issues happening in the economy like we just discussed. And so this is where now understanding that if people are worried about the economy, they're going to flock to safer investments. And now that you can get a decent rate of return or a better rate of return than before on these safer investments, that could lead investors to want to put less money into the stock market for that reason. So this is where now I want you to understand that interest rates have a multi-dimensional attack on different parts of the economy. It impacts spending, it impacts businesses, it impacts the government, it impacts where investors put their money. And so this is why you want to understand now that the higher interest rates that the Federal Reserve Bank is doing, yeah, they're working to cool down inflation and they need to keep interest rates high to keep inflation coming down, maybe even raise interest rates more. But there are impacts of the higher interest rates. And there's many different layers of impacts that you want to understand. And all these things have kind of consequences and side effects. And unfortunately, they're necessary side effects. But this is where I want you to be a financially educated investor that we can understand what's happening. And again, if you want to learn more, we have a free ebook at Briefs Media that you can read. I got the link for you down in the description. But this is where I want you to use this time to build your financial education, to build your financial preparedness. That way you have the knowledge and the resources necessary to be able to capitalize on opportunities that might be coming your way. There are 5 big money lies that are keeping so many people poor. And I can virtually guarantee that every single one of you watching this video have heard some variation
definition of these money lies before. So what I want to do is I want to start by going over what these money lies are so you understand them. And then number two, I want to go over what you can actually start doing with your money today with actionable step-by-step